Hi everyone. Today we're going to talk about Intel's first quarter 2026 earnings, reported on April 23rd. It's a big one, 6 straight beats. AI revenue at 60% of the whole business, and a CEO who joined just over a year ago saying this is a fundamentally different company. So, let's see if the numbers actually back that up.
6. That's how many quarters in a row Intel has now beaten its own guidance. Revenue, gross margin, and earnings, all three above the high end. For a company that 12 months ago was the cautionary tale of American semiconductors, that's not nothing. So let's see what's underneath the streak.
60% of Intel's $13.6 billion in revenue this quarter, 60% came from AI-related businesses, and that bucket grew 40% year over year. 6 months ago, this would have been called wishful thinking. Today, it's a line in the CFO's prepared remarks. Intel isn't selling AI as a story anymore. It's reporting AI as a number. Quick framing before we go deep. Intel reports 3 segments. Let's spend 90 seconds on the basics so the rest of the call lands.
3 buckets. CCG is the consumer business, the chip in your laptop, $7.7 billion. DCAI is data center and AI, Xeon server CPUs plus custom ASICs for the hyperscalers, $5 billion. Intel Foundry is the contract manufacturing arm, $5.4 billion, but most of that is Intel making chips for itself internally, and then $600 million in the Mobileye and other bucket. Got it? Good. Now the fun part.
Here's the macro picture Lip-Bhutan paints. The total addressable market for semiconductors is now approaching $1 trillion, driven by AI. And Intel is the only company in the world that has all 3 of the x86 CPU franchise, advanced packaging technology, and its own fabs. NVIDIA has design but no fabs. TSMC has fabs but no x86. AMD is fabless. Intel's pitch is that vertical integration is finally an advantage again. Whether you buy it depends on whether the foundry lands. We'll get to that. 6 tiles. Revenue $13.6 billion, up 7% year over year, and $1.4 billion above the midpoint of January's guide. Non-GAAP gross margin 41%. Non-GAAP operating income $1.7 billion, more than double last year. EPS 29 cents non-GAAP, up 123%. Operating cash flow $1.1 billion. But, bottom right, GAAP EPS is negative 73 cents. That's the gap we have to explain. Next slide. 5 quarters of bars marching up and to the right. Q1 2026 lands at $13.6 billion, slightly below Q4, but Q1 is normally the seasonal trough of the year. Above seasonal performance, strong execution, growing factory output. The streak is real, and it's not just more than last year, it's more than what Intel itself told us to expect 6 quarters running. Same 6 quarters, but a different cut. The hatched band on each row is Intel's own guidance for that quarter, the range they told the street to expect. The solid bar is what they actually printed. The small tick is the midpoint of the range. Every single row, the bar clears the top of its band. That's the 6 straight beats claim, proven visually rather than asserted. Notice that Q1 26's bar isn't just inside the range, it's a full 0.4 above the top. This is what a streak looks like when you draw it. Here's the bridge. Start at $1.5 billion in non-GAAP net income. Subtract $4.1 billion in restructuring, most of which is a goodwill write-down on the Mobileye subsidiary. Accounting charge, no cash. Then $600 million in stock-based comp. Then $1.1 billion in mark-to-market on shares Intel has in escrow as part of its CHIPS Act deal with the U.S. government. End up at the GAAP loss of $3.7 billion. Strip the noise. The core engine made $1.5 billion. Both numbers are real, they just answer different questions. Same 6.5 percentage point beat, but unpacked. Mix added about 1.5 points, more high-end Xeons in the quarter's volume. Pricing added another point, and 18A yields contributed around 4 percentage points, more than half the beat, and the piece that compounds over future quarters as the node matures. The other 2 are quarter to quarter, yields are structural. Now let's go segment by segment. Where did the money actually come from? The pie.
CCG, consumer PC chips, is 57% of revenue, still the engine. DCAI, server and AI, is 38% and growing the fastest. The Foundry slice on the dial is just the external piece, $174 million, because most of Foundry revenue is Intel making chips for itself, which gets eliminated in consolidation. And then $600 million in the Mobileye and other bucket. Now, who's growing?
This is the key visual of the segment story. DCAI plus 22% year-over-year, the headline grower. Foundry plus 16%. CCG plus 1%, basically flat. And the apparent drop in all other is just because Intel sold 51% of Altera last September. The comparison is mechanical, not operational. The shape that matters, DCAI, is the steepest line. AI demand is showing up in dollars, not just narrative. CCG is the steady leg, $7.7 billion, up only 1% year-over-year. Sequentially down, which is normal Q1 seasonality, but underneath, AI PC revenue grew 8% quarter-over-quarter and is now over 60% of Intel's client CPU mix. Core Ultra Series 3 launched this quarter. Intel called it their strongest product launch in 5 years. Operating margin 32.6%. Healthy. One caveat, management is pre-warning that the PC TAM weakens in the second half. Don't expect this line to accelerate, expect it to hold.
This is the slide. DCAI, $5.1 billion, up 22% year-over-year, up 7% sequentially. Operating margin doubled from 14% a year ago to 30.5% today. The standout subline, ASIC revenue grew 30% sequentially and nearly doubled year-over-year. Two big proof points behind that. A multi-year deal signed this quarter with Google to power their workload-optimized C4 and N4 instances. And pay attention to this one. Intel's Xeon 6 was selected as the host CPU for NVIDIA's DGX Rubin NVL8 systems. Inside the next-gen NVIDIA I box, the orchestration brain is an Intel chip. That's the AI thesis in one bullet. Same 14 to 30.5 story as the hero, but with the arc visible across all 5 quarters. Notice there's no give-back quarter. Every quarter holds or improves on the prior. Q2 is where mix shift to Xeon 6 starts. Q4 is where ACIC ramps in. Q1 of 2026 is where it lands at 30.5, a full 16.5 percentage points above where the segment was a year earlier. Foundry is the most controversial segment, so let's be honest. $5.4 billion in revenue, but most of that is Intel making chips for itself. The truly external piece is $174 million. Tiny. The operating loss this quarter was $2.4 billion, slight improvement from last quarter's $2.5. This is going to lose money for at least another year, probably 2. The reason management is still patient, Intel 18A is now in volume production, fastest product ramp in 5 years, and 14A, the next node, is showing maturity and yield ahead of where 18A was at the same point. That's the leading indicator that lets you draw the curve where these losses narrow. Okay, revenue side covered. Now the spending side. Where did the cash actually go this quarter? The waterfall. Revenue 13.6. Cost of sales eats 8.2. Gross profit 5.3 billion. A GAAP gross margin of 39.4. R&D 3.4 billion. MG&A, which is marketing, general, and admin, 1 billion. Without the restructuring line, Intel would have printed positive GAAP operating income, about 900 million, but the restructuring took out 4.1 billion. Most of that, 3.9 billion, was the Mobileye goodwill impairment. Add tax and other, and you arrive at the 3.7 billion net loss, the headline. But we already know what that is. 3 lines, 3 stories. Cost of sales up only 3% on 7% revenue growth. That's operating leverage in one number. R&D actually down 7% year-over-year, while Intel is simultaneously ramping both 18A and 14A. That's hard. Marketing and admin down 12%. That's the new culture Lip Bhutan is building. Discipline is real.
One caveat, management told us to expect full-year operating expenses modestly higher than the roughly $16.5 billion target because of inflation in memory, wafer, and substrate inputs. So the discipline holds, but the cost base will drift up.
Cash flow. Operating cash flow $1.1 billion, actually up versus Q1 last year, but gross capital expenditure was $5 billion in the quarter alone, most of that on 18A capacity. About $2.1 billion of that was offset by CHIPS Act money and joint venture partner contributions, but that still leaves adjusted free cash flow at negative $2 billion for the quarter. Intel is still consuming cash. That's not a surprise, they told us they would, but it's a real number, and the bear case lives on this slide. The silver lining, a year ago that number was negative $3.7 billion, so the gap is closing. What comes next?
Q2 guidance, revenue range $13.8 to $14.8 billion, midpoint 14.3. That's 2 to 9% sequential growth. Both CCG and DCAI expected up. DCAI up double digits sequentially. But gross margin guided to 39%, a step down from this quarter's 41%. Two reasons. First, 18A wafers are becoming a bigger share of mix, and 18A is still early in its ramp, so it's margin dilutive in the short run. Second, some inventory benefits that helped Q1 don't repeat in Q2. The 18A piece is the right kind of margin pressure. It means Intel is selling its leading-edge chips just at a yield curve that hasn't peaked yet.
The shape of the year. Q2 midpoint 14.3 would be a new high above any quarter in the last 5. Management says servers will run above the seasonal norm in the second half and PCs will run below. They're explicitly guiding the PC unit TAM down by low double digits. Net effect, revenue in H2 is roughly flat to slightly above H1. The story of 2026 isn't acceleration anymore, it's stabilization at a higher base, while the Foundry inflection is still ahead of us in 2027 and 2028.
The relationships. Google, multi-year Xeon deal, plus co-developing custom IPU chips. NVIDIA, yes, NVIDIA, picking Xeon 6 as the host CPU for DGX Rubin, their next-generation flagship AI server. Samba Nova partnering on a hybrid architecture, combining their reconfigurable units with Intel CPUs. Terafab, the new project Intel just joined alongside SpaceX, xAI, and Tesla, Elon's circle of capital, to refactor silicon process technology. And quietly in the background, Intel just bought out the 49% minority stake in Fab 34 in Ireland, now wholly owned. Each of these is an inbound vote of confidence. Each one prints revenue in 2027 or later. Lock in.
Same deals, different cuts. This is when each one starts printing revenue. 18A is the only bar already in motion. That's where the Foundry numbers come from this quarter. Samba Nova ramps next. Google's C4 and N4 ramp through 2026 and into 2027. Intel 14A's first external wins land in the back half of this year. And the big one, NVIDIA's DGX Rubin, starts shipping into the second half of 2026 and runs through 2027. Everything to the right of today's line is signed paper, not shipped silicone. That's the bear's question. Do these all actually print on schedule? The bull's answer is the fact that all 6 are dated, not aspirational. The honest scorecard. Greens, 18A is ramping ahead of plan. DCAI demand is sustained. Yellows, 14A external customer wins haven't landed yet. PC demand will weaken, and external Foundry revenue is still tiny. Red, adjusted free cash flow is negative $2 billion this quarter, and although management says full-year FCF will be positive, excluding the Fab 34 buyout, the cash burn is the live risk. If you're watching one number over the next 4 quarters, watch the red one.
Okay, verdict time.
Both sides. The bull, 6 consecutive beats. AI now 60% of revenue. DCAI margins doubled. The NVIDIA and Google wins. 18A in volume, and a much stronger balance sheet with $17 billion in cash. The bear, still a multi-billion-dollar GAAP loss this quarter. Free cash flow still negative $2 billion this quarter. Foundry losing $2.5 billion in Q4, narrowing to $2.4 in Q1. PC demand weakening into H2, and input cost inflation about to hit gross margin. Both stories are true. The question is which one the next 4 quarters confirm.
The closing thought. Intel just printed 6 straight beats. The CPU is reasserting itself as the orchestration layer of AI. The Foundry is still burning roughly $2.5 billion per quarter in operating losses. But with 18A finally in volume and 14A ahead of where 18A was, the curve to break even is at least drawable now. If both happen, AI demand sustains and the Foundry inflects, this is one of the great corporate turnarounds of the decade. If only the first happens, Intel becomes a great fabless company that didn't need to own its fabs. The next 4 quarters answer it. We'll be back. That's it for today. Don't forget to subscribe.